X Limited, an infrastructure company, is evaluating a proposal to build, operate and transfer a section of 35 km of road at a project cost of 200 crores to be financed as equity share capital of 50 crore and the loan at the rate of interest of 15% per annum from a financial institution for 150 crore. The project after completion will be open to traffic and a toll will be collected for a period of 15 years from the vehicles using the road. The company is also required to maintain the road during the above 15 years, and after the completion of that period, it will be handed over to highway authorities at zero value. It is estimated that the toll revenue will be 50 crores per annum and annual toll collection expenses including the maintenance of road will amount to 5% of project cost. The company considers to write off the total cost of project in 15 years on a straight line basis. For corporate income tax purpose, the company is allowed to take depreciation at 10% on WDV basis. The financial institutions are agreeable for repayment of loan in 15 equal annual installments consisting of principal and interest. Compute the project IRR and equity IRR. If the company's WACC is 16% and cost of equity is 24%, should the project be accepted. So here what we understand is there is a project taken up at the cost of 200 crore, 50 crore comes from equity, 150 crore comes from debt, and the life of the project is 15 years. At the end of 15 years, it has to be handed over to highway authorities at zero value. The revenue is going to be 50 crore per annum, and the maintenance charges are 5% of the total project cost, which is 200 into 5%. So every year 10 crore have to be spent, and the gross profit from the project is going to be 40 crore. And it was said that they are going to write off the project cost over a period of 15 years, and the company is allowed to take depreciation at 10% on WDV basis, but here nowhere we have information about the tax rate. So these information, that is the write-off, WDV basis, depreciation, are all not going to make any sense for us because we don't know what is the tax rate. Okay, then we have the financial institutions are agreeable for repayment of loan in 15 equal annual installment consisting of principal and interest. It means equated annual installments have to be calculated. It's like EMI. Now, if the project, if the company's WACC is 16% and equity is 24%, should the project be accepted? And we can decide by calculating by project IRR and equity IRR. So first, let's focus on equity IRR. Let's calculate equity IRR. So I'll call it as capital A. We are going to focus on equity IRR. So if I want to calculate equity IRR, I should know what are the cash flows from this project. I should know what is the initial investment in the projects, and I'm talking it only from equity shareholders point of view. So working note 1, initial investment from equity shareholders point of view. So what is the investment made by equity shareholder? Equity shareholder are investing 50 crores. Okay, so we'll say investment made by equity shareholders is going to be 50 crore. Okay, so we'll say figures in crores, right? So this is the investment made by equity shareholders. Then let's find what are the cash flows we are going to get. Working note 2, cash flows available for equity shareholders. So how do we find what is the cash flow? We should know what is the revenue. So item A, we know revenue is actually 50 crores, right? Because that is the information we have, the revenue will be 50 crores. Now from that, let's deduct the maintenance cost. We know maintenance cost is 5% on 200 crore. So it is 200 into 5%. And how much that works out to? It is 200 into 5%, that works out to 10 crore. Okay, so revenue is 50, maintenance cost is 10. So let me arrive at the cash flow before payment of loan commitments. Okay, so it is 50 minus 10, 40. But this cash flow is not available for equity shareholders because you have to pay interest, you have to pay principal. So how do we find what is the interest and principal that got to be paid? For that we need a working note. let's find out working note. Let's find out what is the amount that got to be paid, because the question says the financial institutions are agreeable for repayment of the loan in 15 equal annual installments consisting of principal and interest. Okay, it means whatever you are going to pay over the period of 15 years along with the interest, its present value is going to be equal to the loan amount. So working note 3 is computation of equal annual installment of loan. Okay, and there we can say the present value of loan, whatever the loan we have taken, the present value is nothing but the loan amount, should be equal to annuity multiplied by present value annuity factor at the discount rate. What is the discount rate for the loan? The loan is 15%, right? So it should be at 15%. So 15%, comma, how many years? 15 years. So this will help us to find out what is the loan, and we know loan is 150 crore. So this 150 crore should be equal to the annuity multiplied by the present value annuity factor at 15% for 15 years. So let us go to the table, present value annuity factor table. So this is my present value annuity factor table. I have to go to 15%, okay, across 15 years, and I get the number as 5.847. So let me go back. What I get is 5.847. Okay, so this tells me my annuity. My annuity is nothing but this 150 divided by 5.847. So this is my annuity. So what's my annuity? Annuity is 25.65. Okay, so now I'll come back here. I have the cash flow before payment of loan. Now let me pay the annuity, less annuity. Okay, so I have to pay this annuity of 25.65. So only after paying this, whatever I have will be the cash flows available for equity shareholders. So item E, cash flow available for equity shareholders. Okay, and that's going to be this 40 minus 25.65. It is 14.35. This is the cash flow available for equity shareholders. So now we know what is the cash flow available for equity shareholders. We know what is the investment. Then finding equity IRR should be simple. Let's see how to go ahead. Let's proceed with the equity IRR computation. I'll call it as working note 4, computation of equity IRR. See, what is the fundamental of IRR concept? At IRR, we know that at IRR, NPV is going to be equal to 0. Why at IRR, NPV is going to be 0? Because at IRR, the PV of inflows will be equal to PV of outflows. So that's the logic. PV of inflows will be equal to PV of outflows, so NPV is going to be 0. Now, how do we arrive at the PV of inflows? PV of inflows is nothing but annuity multiplied by present value interest factor annuity at IRR rate for the given years. In our case, it is 15 years. And this should be equal to the present value of outflows. Okay, this should be equal to the present value of outflows. Now again, let me fill up. I know what is my annuity, that is cash flow from equity shareholder point of view, which is 14.35. So this will be 14.35 multiplied by the present value interest factor annuity at IRR for 15 years, and this should be equal to the present value of outflows, which is 50 crores. So this tells me my PVIFA at IRR for 15 years, okay, is going to be equal to 50 divided by 14.35. So let me calculate that. PVIFA at IRR for 15 years is going to be 50 divided by 14.35, and it tells me it is 3.484. And this is not my IRR, this is only my present value interest factor annuity. So what it says is, at IRR across 15 years, I'll be getting the value, the factor value as 3.484. So this is the guideline for me. So I have to find out at what rate I would get the factor value as 3.484. So let me go to the present value table. So here I have the table, and unfortunately the table what I have is only for the period up to 20%, and what's the life 15 years, and if I look at 20% 15 years, it is 4.675. okay, whereas the number which I'm looking for, is 3.484. So that clearly tells me that my IRR is greater than 20%, because 20%, okay, and 15 years the value is 4.675, and if you notice the value is coming down. Okay, it is coming down from 7 to 4.6, and it should go down further so that I can land at 3.485. It means I have to calculate this present value interest factor annuity manually now. Okay, so that I can arrive at the exact IRR. So what I'll do, I'll try calculating PVIFA, say somewhere at 25% for 15 years. So how do we do that? What is the formula? Let me give you the formula. It is the formula for present value interest factor annuity is, let me open a bracket, it is 1 plus I, okay, close the bracket, to the power n minus 1, okay, then close this whole bracket, divided by I multiplied by, again, 1 plus I close the bracket to the power n. So this is the formula for computing the present value interest factor annuity, which you would have come across in the time value of money chapter. Okay, so now I'll use this formula. It is, I'm going to take, I'll do one thing, I'll copy this formula here. Yeah, now I'll remove this apostrophe. So 1 plus I, I'm going to replace I with 25%, that is 0.25, and to the power n, my n is going to be 15 years, minus 1, close the bracket, divided by I, my I is 0.25, okay, multiplied by 1 plus I, which is 0.25, to the power n, which is 15. And if I do this, it gives me a number. Let me check its correctness. So I have made a small alteration in the formula. I mean, there is no change in the formula, but the places where I introduce the brackets that become more important. So I'll just show you what are the changes I have done. So I have taken 1 plus I to the power n. So this should be closed. Okay. So we need a bracket here to close this. Then we need a bracket to cover the entire denominator, that is this region. Okay. So I had 3 brackets. Then I also need brackets for the denominator. Okay, and that helped me. So let's see whether I have all those. Yeah, I had 3 brackets in the beginning, then 1 plus 0.25. The first bracket helps me to close this 1.25 to the power 15, and that second bracket helps me to close that minus 1, and third bracket that takes care of my numerator, and divided by, I have opened a bracket 0.25 multiplied by, again I have opened a bracket, I need 2 brackets, because one to take care of this 1.25 and the other one to take care of this entire segment. Okay, so that tells me the value is 3.859. okay, but what is the value we are looking for? It is 3.484. So this tells that your IRR is not even 25%. You have to try with a different number, because you're not getting the number closer to 3.484. So what we'll do, we'll try say PVIFA at 30%. We'll try at 30%. So we should know how this formula will work. So let me copy the formula. So I think yeah, here I need one more formula, one more bracket. Okay, so I think that should be fine. So what I'll do, I'll just copy paste. So wherever I have 0.25 here, I'll replace them with 0.30. Wherever I have 0.25, I'm replacing them with 0.30. So that will tell me what is the present value annuity factor at 30%. So look at here, it is 3.268, whereas here it is 3.859, and what you're looking for is 3.484. So that clearly tells you that your IRR is lying between 25 and 30%. So what I'll do, let me capture this. My PVIFA at 25%, how much? It is 3.859. What is my PVIFA at 30%? It is 3.268. Now, what is the difference between these two rates? I know the difference between these two rates is 5%, and that difference is going to cause difference in my present value factor as 0.591. Okay, so the difference is 5%, and this 5% is going to cause a difference of 0.591 in my factor. Okay, but I'm not bothered about this entire difference. I'm bothered about the difference between 3.859 and 3.484. What is this difference? This is 0.375. And what I understand here is 5% will cause a difference in factor of 0.591. Then what percentage change will bring change in the factor as 0.375? So I'll put that here. It is 0.375. So what would be the change? Let me keep it at 3 decimal. So how do you find it? I have to do the cross multiplication. That is, I should multiply this 0.375 with 5% divided by 0.591. Let me do that. I'll take 0.375 multiplied by 5% divided by 0.591, and if I express this as percentage, it's going to be 3%. So what you have to understand is PVIFA 25% 15 years is 3.859, 30% is 3.268, and we are bothered about some value which is in between. What is the value we are bothered about? We are bothered about a value called 3.484. So what we did is we found the difference between these two, and that was 0.591, and that basically represents 5% change, and the difference between these two is only 0.375, and that represents 3% movement from 25%. So that tells us PVIFA at 28% across 15 years is going to be 3.484, and this clearly communicates your IRR, okay, is equal to 28%. So you got the message that your IRR is 28% through this calculation. So now let's ask a question. Let's go back to the question. See, the question says compute project IRR and equity IRR, which we have done now, equity IRR. And if the cost of equity is 24%, should the project be accepted? Look at the return for the equity shareholders. It is 28%. The expectations of equity shareholders can be expressed through a symbol called KE, and it was 24%. Okay. Here, your IRR is actually greater than the cost of equity. The returns are greater than expectations, so this project can be accepted from equity shareholders' point of view. Okay. Now we should also evaluate this project from lender's point of view. Let me make use of all the calculations. Let me change this as item B, where we'll find the project IRR. The IRR calculated from the point of view of lender will be called as project IRR. And working note 1, initial investment from project point of view. I'll call it as project point of view. Initial investment from project point of view. Then in that case, it's going to be total investment. It's going to be total investment, and the figure will be 200 crores. Okay. Then cash flows from project point of view. Cash flows from project point of view. And here we have to consider all the cash flows, because it is from this cash flow interest have to be paid, then loan have to be paid, dividend have to be paid. So what we'll do, we'll take the revenue 50 crore granted, maintenance cost 10 crore, cash flow before payment of loan 40 crore. Let us ignore this loan repayment, and let us delete this also. So the cash flow before payment of loan is the cash flow that we should take into consideration when we calculate the IRR from project point of view. Okay, so I'm ignoring the cash flows related to interest, the loan repayment. So the question of calculation of equal installment of loan does not arise here. Okay, then we'll move on to working note 3, where we'll find project IRR. I'll call it as working note 3, and it is going to be called as project IRR. And what is the fundamental at IRR? What we know is at IRR, NPV is going to be 0. That is, PV of inflows will be equal to PV of outflows, meaning annuity multiplied at IRR for 15 years should be equal to PV of outflows. And we know annuity. What is the annuity? We have calculated annuity as 40. So let me change it. This should become 40. And what is going to be the PV of outflows? The cost of project, this should be viewed as 200. Okay, so this will help us to find out the present value interest factor annuity. So I'll make it like this: 200 divided by 40. So my present value interest factor annuity at IRR for 15 years, okay, is going to be 200 divided by 40, and it tells me the value is 5. So now what I should do, I should go to the present value interest factor annuity table. Let me go to the table. So here I have to trace it across 15 years. I have to see whether I have any value which is coming closer between. What is the value we have? It is 5. We want a value which should come closer to 5. Look at 19%, at 20% across 15, it is 4.876 at 19%, whereas 5.092 at 18%. Okay, so we'll capture this information. PVIFA at we have a value at 18% and 19%. We'll capture the respective value. What is the value of PVIFA at 18%? Let me capture. At 18%, it is, I don't want the formula now because I have the value. What's the value? It works out to 5.092. Okay, and PVIFA at 19%. At 19%, it works out to 4.876. 4.876. So this clearly tells me that my IRR is lying between 18 and 19. So what I'll do, let me remove all this. Yeah. So the difference between these two rates is 0.216, and it represents 1%. Okay, and we are bothered about the value at which my PVIFA should be 5. So what is the difference between these two? 5.092 minus 5. 5.092 minus 5, the difference is 0.092. So I should know what percentage will cause this change in this factor. That is 0.092 multiplied by 1% divided by 0.216, and if I express that in percentage, let me take it, it's going to be 0.43. Okay, so I started at 18%, and if I move by 0.43, I would get the value as 0.092, and that will help me to reach at 5. Okay, to understand that, let me show it like this. We are bothered about the value of 5, so we should move from 5.092 to 5. So at what rate you will get the value as 5, and our calculation proves that PVIFA at 18.43% across 15 years, okay, is going to give us the value as 5%. So this means the IRR this means IRR is 18.43%. So we got the critical information. I mean, the one which we are asked to test, that is IRR, is 18.43%. And go back to the question. Question says WACC is 16%. That is the minimum return. Okay. So WACC can be expressed using a symbol KO is equal to 16%. Okay. and your IRR is 18.43%. So what you can say is your IRR is greater than the cost of capital, so you can say accept the project.